Welcome back to the Daily Crypto Roundup. As we move through today's session, the crypto market is showing a noticeably different tone compared to what we've seen over the past few weeks. Not euphoric, not aggressive, but calmer, more controlled, and arguably more constructive. Prices are grinding higher rather than exploding. Sentiment is stabilizing rather than swinging wildly. And beneath the surface, there's a growing sense that capital is beginning to re-engage with risk, cautiously, selectively, and with far more discipline than earlier in the cycle. Starting with the top of the market, Bitcoin is trading right around $93,000, holding near recent highs and continuing to consolidate after its latest push upward. Ethereum is sitting just above $3,100, remaining steady and resilient as it tracks Bitcoin's broader market structure. XRP is trading around $2.18, one of the stronger performers among the large caps today, and showing relative strength versus both Bitcoin and Ethereum. Solana is hovering near $135, cooling slightly, but still holding its broader uptrend structure. Binance Coin is trading around $903, continuing to move sideways with low volatility. Dogecoin is changing hands near 15 cents, once again participating in the broader market move rather than lagging behind. Cardano is trading just under 41 cents, still range-bound but showing signs of stabilization. And lastly, Avalanche is sitting around $14, holding key support as traders watch for a potential momentum shift. One of the clearest signals that something has shifted today comes not from price alone, but from sentiment data. The Crypto Fear and Greed Index has officially flipped back to neutral territory for the first time since October. That might sound like a small detail, but for seasoned market participants, it's a meaningful change. Neutral sentiment doesn't mean the market is bullish. It means fear is no longer dominating decision-making. Historically, these transitions often occur during accumulation phases, where capital quietly positions ahead of a larger directional move. Analysts at Sentiment and Glassnode have both pointed out that periods where sentiment resets from fear to neutral tend to coincide with long-term holders increasing exposure rather than distributing. Michael van de Poppe noted earlier today that this kind of sentiment shift often reflects smart money stepping in before narratives become obvious again, adding that the absence of extreme optimism is, paradoxically, a constructive signal. That sentiment backdrop helps explain why today's price action feels steadier rather than explosive. Bitcoin's recent advance has now extended into a fifth consecutive session of higher closes, but each move has been met with consolidation rather than sharp pullbacks. According to market technicians at Fairlead Strategies, this kind of structure suggests trend continuation rather than exhaustion, provided only if key support zones continue to hold. Ethereum, meanwhile, is benefiting from renewed interest around on-chain activity and long-term positioning rather than short-term speculation. Analysts at Bernstein have reiterated that Ethereum remains one of the most institutionally understood crypto assets, particularly as conversations around tokenization, real-world assets, and blockchain infrastructure continue to evolve. While Ethereum hasn't been the headline mover today, its ability to track Bitcoin without underperforming is quietly bullish in the eyes of many portfolio managers. XRP, however, has emerged as one of the standout performers during today's session. Market data shows XRP leading gains among major cryptocurrencies, outperforming both Bitcoin and Ethereum on a relative basis. This move is being closely watched, not because of a single catalyst, but because of how it fits into a broader narrative around regulatory clarity and institutional re-engagement. Several analysts have pointed out that XRP tends to respond early to shifts in regulatory sentiment, particularly in the United States. With market structure legislation continuing to make progress, and policymakers signaling a more defined framework for digital assets, traders appear increasingly comfortable pricing in longer-term use cases rather than purely speculative flows. That regulatory theme is becoming increasingly global. One of the more notable developments today comes out of Japan, where the country's finance minister has declared 2026 the year of digitalization, explicitly highlighting crypto assets, tokenized markets, and digital finance as national priorities. Japan has long been one of the more progressive jurisdictions when it comes to digital assets, but this statement elevates the conversation to a strategic level. Analysts at Nomura have described Japan's approach as methodical rather than speculative, focusing on infrastructure, compliance, and integration rather than short-term innovation. For the broader crypto market, that matters, because it reinforces the idea that adoption is no longer confined to startups or fringe use cases. Instead, it's being embedded into national financial strategies, particularly in regions that value regulatory clarity. Before we get into the next big headlines, we are going to pause here for a quick word from our sponsors. Stay with us.
At Arizona State University, we've made online education better, smarter, and more personalized, so you can go further in your aspiring field.
I decided to pursue medicine once I realized that ASU did have the online program for biological sciences. You're still required to learn the same curriculum. You're still being tested on the same content that anyone would be tested on in person. The comprehensiveness of the program prepared me so well for medical school.
Explore over 350 plus programs at asuonline.asu.edu.
This international momentum contrasts sharply with another development making headlines today, highlighting crypto's growing role in geopolitical finance. Reports indicate that Israeli and foreign banks have blocked certain aid flows into Gaza, pushing donors toward crypto-based alternatives. This is a sensitive and complex issue, but from a purely market perspective, it underscores crypto's function as a parallel financial rail when traditional systems become constrained. Analysts at Chainalysis have repeatedly noted that crypto usage spikes during periods of financial restriction or political friction, not because of ideology, but because of necessity. While such use cases raise important regulatory and ethical questions, they also reinforce why digital assets continue to attract attention from governments and institutions alike. Crypto's ability to operate outside conventional banking systems remains one of its most disruptive and controversial features. Institutional involvement remains a dominant theme today, particularly following a striking disclosure from Bitmine Immersion Technologies. The company announced that its Ethereum holdings have reached over 4 million tokens, with total crypto and cash assets exceeding $14 billion. That number immediately caught the market's attention, not only because of its size, but because of what it implies about institutional conviction. Analysts at Galaxy Digital described the disclosure as a clear signal of long-duration positioning, noting that entities holding that scale of assets are not trading short-term volatility. Instead, they are aligning with long-term theses around blockchain infrastructure, staking yields, and network effects. Ethereum's role as a settlement layer and programmable financial platform remains central to that thesis. This kind of accumulation also helps explain why downside volatility has been relatively muted. When large holders absorb supply during dips, it dampens panic selling and stabilizes price action. According to data from CryptoQuant, long-term holder balances have been trending upward again over the past several weeks, reversing the distribution phase seen earlier in the year. Regulation continues to evolve in parallel. In India, reports confirm that 49 crypto exchanges have registered with the Financial Intelligence Unit as part of a broader push to curb money laundering and illicit finance. While regulatory compliance is often viewed negatively by retail traders, institutional participants tend to see it as a prerequisite for sustained capital inflows. Analysts at JP Morgan have repeatedly argued that markets perform best when regulatory uncertainty is reduced, even if compliance costs increase. India's move, while restrictive in some respects, provides clearer operating parameters for exchanges and investors alike. Over time, that clarity could support deeper liquidity and more stable market participation. Another notable development today involves rising interest in tokenized commodities, particularly tokenized gold. Demand for Tether gold has reportedly increased as investors seek defensive exposure within the crypto ecosystem. This reflects a broader trend where capital rotates not out of crypto entirely during uncertain periods, but into lower volatility digital assets that maintain blockchain exposure. Analysts at Being Crypto and Kaiko have both observed that tokenized real-world assets often see inflows during periods of macro uncertainty. They serve as a bridge between traditional risk management strategies and digital asset infrastructure. While these instruments don't generate the same headlines as meme coins or high-beta altcoins, their growing adoption speaks to the maturing composition of crypto portfolios. Professional services firms are also leaning further into the space. PwC has publicly signaled increased engagement with crypto clients, citing stronger political and regulatory support in key markets. According to analysts at the Financial Times, this shift reflects not just demand from crypto-native firms, but growing interest from traditional corporates exploring blockchain applications. When firms like PwC expand their crypto practices, it typically follows sustained client demand, rather than speculative enthusiasm. Their involvement brings additional layers of governance, compliance, and institutional credibility, factors that historically precede broader capital allocation. Pulling all of this together, today's market feels less like a breakout and more like a reset. Risk appetite is returning, but it's doing so methodically. Sentiment is neutral rather than euphoric. Institutions are accumulating rather than chasing. Regulators are clarifying frameworks rather than threatening blanket bans, and prices are grinding higher rather than spiking uncontrollably. From a technical perspective, analysts are watching a few key levels closely. Bitcoin holding above its recent support zone remains critical. A sustained move beyond its current range would likely invite momentum-driven participation, but failure to hold support could reintroduce short-term volatility. Ethereum's relative strength against Bitcoin is another area of focus, as shifts there often precede broader altcoin rotations. XRP's performance will also be closely monitored. Continued outperformance could signal renewed confidence in regulatory outcomes and utility-based narratives. However, analysts caution against overinterpreting short-term moves, emphasizing the importance of volume confirmation and follow-through. Looking ahead, macro factors remain an underlying influence. Interest rate expectations, geopolitical developments, and equity market performance all feed into crypto's broader risk profile. However, today's developments suggest that crypto is increasingly responding to its own internal dynamics, rather than simply mirroring traditional markets. That's an important evolution. As the asset class matures, correlations shift, narratives deepen, and price discovery becomes more nuanced. We are seeing that play out in real time, not through dramatic headlines alone, but through quieter signals like sentiment indices, institutional disclosures, and regulatory alignment. As always, the key takeaway is context. Individual headlines matter, but it's the convergence of trends that shapes market direction. Today's convergence points towards stabilization, cautious optimism, and long-term positioning, rather than speculative excess. That's where we'll leave it for today. Drop your thoughts in the comments, let me know what you're watching in the market, hit like, follow and subscribe if you haven't already, and as always, we will see you at the top.